Hello and welcome back. It's currently 11:45 p.m. Eastern Time on Wednesday, August 6, 2025. Today, 3 of the 4 major U.S. indices closed higher, with only the Russell lagging slightly. Led by strong performances from Amazon, Apple, and Tesla, the broader market saw gains of over 1%. There was an unusual development in the bond market today. Right before the 10-year Treasury auction, an unexpected fat finger trade triggered a wave of sell-side algorithmic activity and stop-loss orders. As a result, yields on the 10 and 30-year Treasuries briefly spiked over 1 percentage point, only to quickly retreat. Trading volume for 10-year notes surged to over 300,000 within 30 minutes, compared to just 70,000 for the remainder of the day. It might have just been someone spilling coffee on their keyboard. Either way, it didn't significantly impact the bond trend, which remains largely bullish after breaking above the 200-day moving average. Let's talk about today's market rebound. Many are still asking the same question. Can we still go higher, or are we headed for a deeper pullback? Our outlook on the S&P 500 remains unchanged. It's currently in a neutral zone. If it breaks above 64.2, the market may re-enter the prior bullish range. However, if it drops below 6,188, we could be looking at a deeper correction. On the macro front, several Fed officials took a more dovish stance following last week's disappointing non-farm payroll data. Kashkari suggested that 2 rate cuts this year still seem appropriate, though he noted that if tariffs drive inflation higher, the Fed might pause or even hike rates. Another official flagged July's job numbers as concerning, hinting at a potential economic inflection point. In trade news, President Trump announced plans to impose a 25% tariff on Indian imports, with the potential to raise that to 50%. The reason? India's continued purchase of Russian oil. Let's now dive into individual stock updates. First up, Berkshire Hathaway. After some recent EPS adjustments, forward valuations are mostly unchanged. The 2025 forward range is 400 to 663 with a median of 531, and 2026 is 420 to 696 with a median of 558. Our view on Berkshire is still the same. The aggressive buy zone is between 451 and 472s. A more conservative entry would be below forward $21. If Berkshire drops below support, we could see a large bearish head and shoulders pattern form. Long-term investors must be patient. Berkshire's recent earnings aren't as strong as they used to be, and Buffett is no longer at the helm. Next, McDonald's reported a solid second quarter. Adjusted EPS came in at $3.19 with revenue of $6.81 billion, both beating estimates. Earnings grew 12% year-over-year, and revenue was up 5% thanks to a 3.8% rise in global same-store sales and a 2.5% gain in the U.S. Those gains were largely driven by price increases. However, the company did note a decline in breakfast traffic, possibly due to rising costs and tighter consumer spending. McDonald's current price is around $307, close to the 2025 forward valuation median of $302. The 2026 forecast ranges from $285 to $368, with a median of $326. Technically, the stock recently dipped to $283, found support, and is now back in a consolidation range. If it breaks above 360s, we could see a run toward the upper end of 2026 valuations. Let's turn to Disney. Q3 earnings per share were $1.61, beating expectations of $1.45. Revenue rose 20% year-over-year to $23.65 billion, slightly missing estimates. Profit margins in the entertainment division dropped to 10.1%, while theme park profits rose 10%. The big highlight, Disney's streaming business posted a profit for the first time, with profit margins improving from 11 to 13%. However, traditional TV revenue fell 28%, with a $21 million loss this quarter. To counteract this, Disney is betting big on sports. It plans to launch a standalone ESPN streaming service in 2026, priced at $30 a month. As part of this strategy, Disney will acquire a 10% stake in SPM and integrate several NFL media assets. Once complete, Disney will own 72% of SPM. Disney's current price is around 150 years, which aligns with the median 2025 forward valuation of $170. The 2026 range is $101 to $158, with a median of $130. Support levels lie between $107 and $150. A drop below 107 would break key technical levels and suggest the stock may trend lower. Next up, let's briefly look at Adobe. Revenue was $12.6 billion, up 10% year over year and beating estimates. EPS grew 90% to 10.1, but free cash flow was just $768 billion. The 2025 forward range of $251 to $335 appears overvalued compared to the current price of $390s. However, 2026 projections are stronger, with a range of $357 to $476, median $416. Key technical support lies between $390 and $53. A break below $250 would signal significant deterioration in fundamentals and potential entry into a bearish trend. Moving on to Uber, Q2 EPS came in at 63 cents on revenue of $16.51 billion, both beating estimates. Gross bookings rose 10% to $46.8 billion, and monthly active users increased 15%. Uber expects Q3 bookings between $48.25 and $49.75 billion. The company also plans to deploy 20,000-plus autonomous vehicles over the next 6 years. Despite fierce competition from Waymo and others, Uber's bookings remain stable. The 2025 valuation range is $87 to $116, with a median of $101, while 2026 ranges from $105 to $140s. However, the 30% compound growth assumption behind these numbers is aggressive. Given the intensifying competition, achieving that level of growth remains uncertain. A more reasonable buy zone is between $77 and $80, with a conservative range of $70, $8 to $75. 3. Next, TSMC. After concerns about upcoming semiconductor tariffs, President Trump clarified that companies like TSMC that already manufacture in the U.S. or have committed to doing so will be exempt from the new 100% import tax on semiconductors. That's great news for TSMC, which has active U.S. facilities and expansion plans. Our current position remains unchanged, holding an 8% allocation with no plans to reduce. We aim to ride the cycle through mid-2026 with a target price between $200 and $250. AI demand continues to be strong, and while September tends to be weak seasonally, the fourth quarter and early 2026 are expected to be robust. Now let's go over Apple. Today, CEO Tim Cook met with President Trump at the White House to announce a $100 billion investment in U.S. manufacturing. Apple pledged to invest a total of $600 billion over 4 years and hire 20,000 U.S. employees. However, many see this as a symbolic gesture rather than a fundamental shift. Most of Apple's products are still exempt from the highest U.S. tariffs, so this announcement likely aims to maintain that favorable status. From a business standpoint, reshoring production to the U.S. would increase costs, potentially pushing product prices higher. Our outlook remains cautious. Apple is trading between $220 and $236, having already touched $213 during the day and climbing to $209 after hours. A break above $220 could trigger momentum buying and a test of $236. However, $236 remains a strong resistance level. Finally, Tesla. The stock rose 3.62% today, contributing significantly to the Nasdaq's gains. Elon Musk has been quieter recently, which is likely a good thing. There's speculation that the board gave Musk a large incentive package because they sensed he was contemplating stepping back or even leaving. For now, he seems committed to staying, and Tesla continues to tease major tech updates, including advances in full self-driving FSD. Technically, Tesla faces a key resistance at $348. A breakout there would likely accelerate upside momentum, but it also depends on broader market strength. If the S&P returns to a bullish phase, Tesla will benefit. If not, it'll have to fight its way up independently, which could slow the rally. That wraps up today's market update. If you found this video helpful, please like, comment, and share it. We'll see you again tomorrow at the same time. Thanks for watching.